All right, so we'll go ahead and dive right into our first questions, and we love our VA buyers. So I wanted to touch on a couple of topics of our couple questions this time around concerning VA loans. So, can VA buyers purchase? Let's do the first one because this came up on my current buyer. Can the VA buyer purchase their home under their trust name?
So the answer is typically no, right? And that it's not just VA loans. A lot of people try to do that. Now, there is a way where they can deed the property into the trust. But in terms of the loan, they're giving the loan to the individual, right? To Jeff Quincey. They're not giving it to the Jeff Quincey Irrevocable Trust. Every lender has different rules on that if they'll let you close in the trust. If they do, they want either a copy of the entire trust or the trust certification. And that's getting underwritten just like the rest of the loan to determine if they'll let you close in a trust. I would say, as a loan officer, the cleanest way to do it is to close in your name and then work with the title company to deed it into your trust. It's one extra step. It's not expensive. And that just cleans up the lending process part of it. You don't want to assume you're closing in a trust and then have the lender 2.5 weeks later say, hey, we can't based on this language in the trust.
So it has to match the DD 214 name on there that on the contract does.
Yeah, everything. Yeah, you want, and that's just standard on all VA loans. You want everything throughout the loan file to match that DD 214 and what we actually pull from the VA, which is called a certificate of eligibility.
Okay. All right, very good. Yeah, we ran into that. We got it fixed right away when we didn't want the hiccup later on.
Yeah, were you able, was that particular client able to close in the trust? Was the lender?
No, they're going to do a post escrow. Yeah.
Yep, after the closing for sure.
Yep.
Very common practice.
Okay. All right. Our next topic on VA loan is what are the benefits of a VA loan? I know there's quite a few, so if you can touch on your top ones.
Yeah, so very easy and straightforward. First off, zero down. Okay. Mm-hmm. Not all VA loans are zero down. VA will give the loan to a veteran or a veteran and their spouse. So if it is a girlfriend, a fiance, boyfriend, fiance, if it is you're trying to buy the house with your VA benefits, but it's your parent or your child on the loan, VA will actually let you do that, but they'll call that a joint application or joint loan, and that requires the normal underwriting process through the lender.
Okay.
And then the file also has to be sent up to VA for sign off on those joint applications, and a down payment is required. And real short, I'll explain why that is. The VA guarantees a portion of that loan to the lender. They guarantee 25%. And we're buying a $400,000 house, and I always tell clients this isn't physically how they do it. You're buying a $400,000 house, and it's you and your boyfriend or girlfriend. They split that $400,000 down the middle, and they say, okay, veteran, we'll guarantee your half, your $200,000. But now your boyfriend or girlfriend, their half has to be matched with that guarantee of 25%. So it equals roughly 12.5. And that's not the exact math, but you have to anticipate putting 12.5% down. But for a standard veteran or a veteran spouse, the number one benefit is zero down with the combination of no mortgage insurance. So that's huge, right? There is no other loan out there that has a zero down option without mortgage insurance present. So you are going to find that that's going to be your lowest payment. Additionally, VA loans have really good interest rates because of that guarantee, right? Anywhere from 0.375% to 0.5% lower than a conventional loan. Other benefit would be, I'm going to talk on a couple things that aren't necessarily benefits. So if the veteran has a disability rating, they don't have to pay a funding fee. Okay. So one thing we look at is if a veteran does not have that disability rating and they have a funding fee, you buy a house for $400,000 with zero down, your loan amount won't be $400,000. It's going to be more than $400,000 because the VA is so nice, they let you roll that in and finance the funding fee. So now we have to look at, does it make sense to do that? Right? What's the overall makeup of the loan? Does the zero down, no mortgage insurance offset that one little negative thing? You know, if you're rolling in, say, $12,000, it's only affecting your payment right now by about $100. Well, if mortgage insurance is $200, then VA is still the better option. One thing I always like to talk about when we talk about VA loans is a lot of veterans are under the impression when we talk about zero down, we are just talking about the half of the transaction about down payment. You still have closing costs, okay? And just like any other buyer, you're still going to pay those standard closing costs. With us as a broker with no lender fees, a house with no HOA is probably going to have closing costs of about $5,000. A house with an HOA is going to have closing costs of about $6,000. What I find when we talk to our veterans is that's the number one item that they've been misguided on. They think it's zero out of pocket total. And of course, as we talked earlier, a lot of sellers are still giving concessions. So we can still ask the seller to pay those closing costs for them. But it is their responsibility initially until we get the seller agreeing to pay for them.
Okay. Okay. The other thing was on credit limits. Those tend to be a little more relaxed.
Well, so VA doesn't have a credit score requirement in their guidelines, but lenders set them. So the most common is 580. There are some lenders that will go lower, but as you know, credit score is risk-based pricing, right? You're going to have higher interest rates in that scenario. There are some lenders that will go below 580 with higher interest rates. Additionally, you triggered me there with the word limit. So it used to be VA loans were limited to the conforming loan limit. So the max conventional loan limit, which is, I always forget the number, like 766, 550 or something like that in Maricopa County right now. So back 5 years ago, you'd be limited to that price point with zero down. Now, about 3 Januaries ago, VA removed that. So I have done a handful of $1 million plus loans for veterans with zero money down. Lenders do self-impose their own loan limits on that, and most common is 2.5 million. So yeah, we've had people out in Queen Creek, Santan Valley, purchase right at 1 million. We had one just over 1.1 million, another one at 1.3 million with zero down. So now those payments are high, but all three of those clients had sold houses and chose to leave those net proceeds from the sale of their house in their bank account and reserves for comfortability to live off of and afford that higher payment.
Okay. All right. Now, I know there's a question that came up on one of my VA buyers. He didn't realize he can use it more than one time.
Yeah.
As a lifetime benefit. Yeah.
Yeah, there's a calculation that you do. So you have full entitlement if you've never used your VA or you're not currently using it and you have full entitlement, then that's where that no loan limit comes into play. If you have if you sell that house and buy another one, you're back to full entitlement. You can use it again. I think where you were going with the question was if you own a house right now with a VA loan, everybody thinks they cannot buy another one if they want to retain that. And you can. It's called bonus entitlement. There's a calculation. I won't go over it here because I'll lose everybody on the math. But we pull that certificate of eligibility. We see how much entitlement's been used on the current house. And then there's a calculation we run through that tells us how much they can buy, like what the max purchase price that they can buy on the next house with zero down. Now, usually it doesn't leave much. Like most of my calculations come in somewhere in the 250 to 350 range. It's not that you can't go higher. You just now have to match the VA's 25% guarantee. So if I run that calculation, it says max purchase price with zero down is 300,000 and you find a house for 400,000, we take that $100,000 delta and you have to match VA's 25% guarantee. So you'd have to put 25,000 down, 1/4 of that $100,000 excess. So there's no cap there. It's just sometimes it's cost prohibitive if we're looking for zero down.
Right. Now, that second purchase, does it have to be primary residence?
Always. Yeah. Occupancy fraud is one of the most number one most investigated thing by FBI. And when you get into VA, that is nothing. I mean, you don't want to deal with the FBI and occupancy fraud, period. But when you're dealing with the VA, you do not want to lose your VA benefits. So it 100% has to be a primary residence that you're moving into. The current one can be converted into a rental, into an investment property. The new one has to be, and then that story has to match, right? If you own a 5,000 square foot home in Gilbert with a VA loan, and you're going and buying a 1,200 square foot house in Mesa that's a 1950 build, and it, night and day, underwriter's going to see what's going on there. And you better have a really good explanation as to verifying that it's really going to be the house you're moving into.
Right. The other thing on VA is they look at, you can use any type of income. Is that correct?
Well, yeah, I mean, really the income that can be used on VA is no different than the income that can be used on other loans, right? So if we have VA disability, we have VA retirement, Social Security, W-2 income, self-employed income, it's all looked at the same. What you have is simply more leeway. So I'll just break this down because I think it's important to know I have this conversation with every veteran. So we always in mortgage, we talk about debt to income ratio, right? Having to have your debts be under a certain ratio of your total gross income. And that's what every loan type looks at, right? And they all have their own individual limit. VA has a debt to income ratio calculation, but they don't put any weight on it. What they put weight on is what's called a VA residual income calculation. There's two reasons I always tell veterans on why VA loans perform well. A, we're giving them to veterans. People that have been part of the military, they're very disciplined. But the bigger reason above and beyond that is how they calculate your approval. They literally take your gross wages, they subtract out monthly maintenance on the house, which is 14 cents a square foot. Then they subtract out all of your monthly debts. Then they make us go pull all of your tax numbers, state tax, federal tax, your Social Security and Medicare. We take that out. And then based on the household size and the region of the country that you live in, the VA has set a guideline that says you have to have left over after all of those deductions, X amount of money. And they put more weight on that. So I was actually approving a veteran this morning where her debt to income ratio is 55%. For any other loan, that wouldn't be good. But her residual income is almost 4 times as much as the guideline. So she's very strong there. The VA, we got a loan approval based on that. I've done a loan, the highest I've seen closed is a VA loan at 70% debt to income ratio. Wow. Because the VA residual was really good.
Yeah.
So we don't put near as much weight. If you're working with a lender, there's a lot of lenders out there that say they're good with VA and they don't know the first step. They look at debt to, hey, you're good. You're at 35% debt to income ratio. And there's people that have low debt to income ratios that fail the residual income test. And if you fail that, you can't do the loan. There's no way around it. So it's good to know, make sure you're working with somebody who understands VA loans.
Okay.